Hi, Richard Hemming here, founder of Under the Radar Report. Like people, not all companies are created equally. It's horses for courses. Not every company can be a Google. Not every company can be a Netflix, an Nvidia, an Amazon. What makes the difference? In 3 words, return on equity. This week, I'm going to show you why you need to take profits on 3 stocks that have run hard. In a nutshell, if you're a contractor, a retailer, or a company that requires vast amounts of ongoing capital expenditure, your returns are by definition going to be limited. Fixed costs play a part, but variable costs are more important. To increase profits beyond a certain level, investment needs to occur. That's why analysts keep banging on about cost of capital. So let's get to it. Which are the companies we need to be taking profits on? Qantas Airways has lived up to its flying kangaroo moniker. There is no doubt. It's returned 65% in the past 12 months, 35% a year in the past 3 years. These returns do not occur ad infinitum. So a big factor driving the stock has been the return on investment in its planes. Specifically, Jetstar has shot the lights out. This enables the company to pay record amounts of dividends, 53 cents or something in the last result. But Qantas is a special case. It has the thinnest equity base of a blue chip I've ever heard of. Certainly, I can't think of anything that comes closer. The equity base, the net assets are less than $1 billion, something like 750 million. It's very small. Why is it able to do that? Because a lot of its sales are prepaid. So that's a liability, like 9 billion or something of sales. So what does this mean? It means ROE is very volatile. 1 minute, it's really in the negatives. The next minute, it's really high in the positive. 1 minute, it's not paying, like for years, it's not paying dividend. And suddenly you get an explosion of dividend. What does this mean? It means it's not a long-term hold. Take profits on Qantas. Next cab off the rank, Downer EDI. Yes, a contractor. Might seem boring, but it's had an unbelievable 20% a year return in the past few years. I looked at Downer as the ugly duckling of the contractor space. Like there were always problems, but the company has been through a huge transformation, going from being a mining company, mining focused, to being infrastructure, utilities. And that has led to basically mid-single digit ROE to well over double-digit ROE. In fact, it's like around 13% forecast to go up to 16%. But what's happening on the sales side is that there's not much forecast sales growth. So these are heroic assumptions on the ROE front. Basically, you cannot keep delivering the kinds of returns Downer has done ad infinitum as well. Time to take some profits. Super Retail is my third stock we should be looking at taking profits on. This stock has returned even more, 50% in the past 12 months, 20% of which was in the results period. Unbelievably big momentum in this stock. The big factor driving the stock recently, the intense competition in the retail space predicted hasn't occurred. In fact, sales in their major franchises just keep going up and the ROE is steady, or their profit margins are steady. So unlike the other two, the ROE at Super Retail has been fairly consistent in the high teens, but the PE has been re-rated from low teens a few years ago, or even last couple of years, to now trading in the high teens. But despite this, earnings growth is not predicted to be any more than mid-single digit. So it's predicted that this company will not grow much. Look, we're not rating these stocks as sells. What we're doing is, having been lucky enough to own them, we're taking risk off the table, we're cashing in. Big returns like that experience do not keep going on and on and on. There are limits to how much people will pay. We're taking some money off the table because that's the sensible thing to do. Trees do not grow to the sky. Look, you've had some wins. Take at least some of it to the bank. Looking forward to talking to you next time.